Hi, Gary DeWall here, and this is Bridging the Week, January 13th to 17th, and today is January 20th, 2014. Good morning. One of the final pieces in the G20 mandate of September 2009 related to OTC derivatives formally will be put in place on February 14, 2014, when certain interest rate swaps for U.S. persons will be mandated from that date forward to be traded on swap execution facilities and designated contract markets. However, once again, the launch of a new CFTC initiative is marred in controversy over the execution of so-called package transactions involving multiple components where only one piece involves interest rate swaps subject to the new mandatory execution requirement. This CFTC action, MiFID II developments, many international proposals relevant to the financial services industry, and a few notable enforcement actions worldwide highlight this week's Gary DeWaal's Bridging the Week, so let's get started. Last week, the CFTC's Division of Market Oversight announced that it had deemed certified Javelin CEF's self-certification of made available to trade determinations of certain interest rate swaps. This now requires that as of February 14, 2014, all such swaps must be traded through a DCM or CEF, and if executed through a CEF, subject to the Commission's trade execution requirements. In issuing this announcement, the CFTC's Division of Market Oversight indicated that in connection with package transactions involving more than one swap or financial instrument, and at least one swap subject to a MAT determination, the swap subject to that MAT determination must be traded through a DCM or CEF. However, the Division of Market Oversight anticipates holding a roundtable to consider, quote, whether and under what conditions to grant limited relief for package transactions to ensure proper implementation of the execution mandate, end of quote. Needless to say, Commissioner Scott O'Malia had a few things to say about this. Among other matters, the CFTC Technology Advisory Committee will meet in Washington, D.C. on January 21st and discuss the MAT determination as part of its agenda. This should be lively. I will be there and will try to tweet anything particularly notable. The European Parliament and European Council, this is the heads of European Union member states, agreed last week in principle to updated rules for markets in financial instruments, so-called MiFID II. The new regime is aimed, among other things, at requiring a shift in the trading of financial instruments to multilateral regulated trading platforms, imposing a harmonized EU-wide system for position limits on commodity derivatives, and strengthening investor protections. Restrictions on certain high-frequency trading will occur too. Non-EU market access by third-country firms to professionals and eligible counterparties will be based on an equivalence assessment of the third country. A transitional period will apply for 3 years for this international aspect. I did an article on this agreement last week on the same day it was announced, which is on my website. Check it out for details. The Bank of International Settlements has issued guidelines on how banks should incorporate anti-money laundering and anti-financing terrorism into their overall risk management program. According to BIS, core elements of an effective risk management program related to AML and anti-financing terrorism should include 1. An assessment, understanding, management, and mitigation of risks, including a robust transaction monitoring system. 2. A defined customer acceptance policy that includes the identification of customers that might pose a higher risk. 3. Customer and beneficial owner identification, verification, and risk profiling. 4. Ongoing monitoring to detect for potentially suspicious and illegal activity. 5. Management information. And 6, I ran out of fingers, reporting of suspicious transactions and asset freezing. Moreover, in global organizations, there must be a global process for managing customer risk, including group-wide information sharing. Break down those pillars. I keep saying that. You gotta share information across pillars. The CFTC fined Multigrain SA and Agricola Xinhua SA, Brazilian-based companies that produce and trade cotton and other agricultural products, $500,000 related to their failure to file with the CFTC weekly required reports related to that physical cotton activities on at least 24 occasions from January 1st through October 31st, 2013. Both companies, by the way, are subsidiaries of Mitsui Corp. Cotton merchants and dealers are required by CFTC rules to file a CFTC Form 304 report related to their physical purchases and sales as of close of business each Friday within 2 business days of the date of the report, whenever they hold or control at least 100 cotton futures contracts. This matter was resolved through an offer of settlement submitted by the respondents. In another enforcement action, the CFTC entered into a consent order with New World Holdings, an introducing broker, related to its failure to retain for 5 years various records prepared in connection with the IB business related to its introduction of an account, including emails. As part of its consent order, New World agreed to pay a fine of $50,000. I have to say, for a small firm, record retention is a difficult task. Think of all the different type of documents related to its business of conducting futures, and think of the difficulty of saving all those documents for 5 years. Physical documents, emails, and email transmitted documents. The Canadian Securities Administrators is seeking comment on its proposed rule related to the protection of customer positions and collateral posted in connection with derivatives trading. The rule, although solely proposed at this time, was issued also to provide quote-unquote interim guidance. The proposed rule establishes requirements for the handling of customer collateral by clearing members, clearing intermediaries, and derivatives clearing agencies, including requirements related to the segregation and use of customer collateral, and is aimed to ensure that, quote-unquote, in the event of a clearing member default or insolvency, customer collateral and positions can be transferred to one or more non-defaulting clearing members without having to liquidate and reestablish the positions. Comments are due by March 19, 2014. The Financial Industry Regulatory Authority barred David Gutman, a former vice president in the conflicts office of J.P. Morgan Securities, and Christopher Tyndall, a former registered representative of Meyer Associates, from the securities industry related to Gutman's passing to Tyndall proprietary information related to 15 pending corporate merger and acquisition transactions from March 2006 through October 2007. Tyndall used the information to trade ahead of relevant public announcements in connection with at least 6 of the transactions and pass along the information to clients to trade, earning both commissions and trading profits. Gutman learned of each pending transaction related to his role in the J.P. Morgan conflicts office. He and Tyndall were childhood friends. A third individual, Joseph Critelli, also a friend of Tyndall, and a representative of Westrock Advisors at the relevant time, was also barred from the industry because he failed to appear for testimony before FINRA related to his trading activity related to the transactions. Wow. Talk about chutzpah. Soy Bun, a futures trader and former licensed intermediary, was required to pay more than 13.5 million Hong Kong dollars or 1.75 million US dollars related to manipulation of index futures contracts from 2007 and 2009 in a criminal action brought by the Hong Kong Securities and Futures Commission. The SFC had alleged that Mr. Bun manipulated the calculated opening price through artificial trades he arranged. The amount of Mr. Bun's payment is meant to restore 500 investors, both in Hong Kong and overseas, the position they were in prior to transactions with him. Mr. Bun is the first person prosecuted criminally by the SFC for market manipulation in the Hong Kong futures markets. And finally, the Board of Governors of the United States Federal Reserve System is seeking comment regarding current authorizations for bank holding companies to conduct activities regarding physical commodity activities and whether there should be additional restrictions. Comments will be accepted through March 15, 2014. Woo! That's a lot to cover. And there are even more stories on the article version of Bridging the Week on my website, along with compliance weeds and my view sections. So, check it out. Until next week, have a great week, and this is Gary DeWaal. Ciao.